Hi and welcome everyone. Bienvenue tout le monde. Thank you for attending the Canadian Medical Association's virtual town hall. I'm Tristan E. Claren. I'm the Director of Engagement at the CMA, and today we're going to talk about the recent prorogation of Parliament and what it means for you and your medical corporation as it relates to capital gains. Today you'll hear about the CMA's advocacy work in this area, as well as from MNP, a leading accounting firm, to provide some insights that we hope are helpful for you. And following these presentations, we will open up the session for your questions. So very quickly, just a few housekeeping items. We are recording today's session for future reference, and there is also simultaneous interpretation for today's session. The option is available to listen in French or English, and that's at the bottom of your screen. And at any time during the town hall, you can add your questions to the Q&A. In addition, we will be asking you to vote on submitted questions that you see that you want us to answer. So to get us started today, I'd like to invite CMA President Dr. Reimer to share a land acknowledgement and opening remarks.
Thank you, Tristan, and thank you really to everyone who has joined us today to talk about this important conversation. Before I get into anything else, I do want to start with a land acknowledgement. While I live in Winnipeg, which is Treaty 1 territory, I'm actually joining you today from Halifax, which is the ancestral and unceded territory of the Mi'kmaq people. And I make this acknowledgement specifically to reflect our medical community's commitment to listening, to learning, walking the path towards reconciliation together, and in recognition of the apology that the CMA did earlier this year to all Indigenous peoples on behalf of physicians and the healthcare system. So I do encourage you to take a moment as well to think about and acknowledge the land that you're currently on, either quietly to yourself, or we would welcome that discussion in the chat as well to hear about where you are. So, as we all know, on the 6th of January, the Prime Minister resigned and prorogued Parliament. Now, prorogue may not be a common word for everybody, but effectively, prorogation of Parliament means that it terminates the current session. And when you terminate the current session, any legislation that has not yet received royal assent is terminated along with that session. And if it ever wants to become law again, would need to be reintroduced from the first step. So this includes the proposed increase to capital gains that was introduced in last year's federal budget, the one that directly impacts doctors who have a medical corporation. So despite the prorogation of Parliament, despite the fact that the capital gains bill never received royal assent and did not pass into law, the day after prorogation of Parliament, the Department of Finance confirmed that the Canada Revenue Agency would continue to collect capital gains taxes at the higher inclusion rate, so the new rate, for all taxpayers, which includes professional corporations. So that announcement has caused a lot of anxiety, a lot of confusion, and certainly a lot of questions, like as a physician, should I or should I not file my taxes using the higher capital gains inclusion rate? What happens if the legislation doesn't get reintroduced when Parliament resumes on March 24th? What if it does get reintroduced? The goal of today's webinar is to provide some clarity and guidance on these and other questions, especially as the tax filing season is quickly approaching. So we wanted to just take a moment to talk about some of the harmful effects of this tax measure, specifically what the effects will be on incorporated physicians, as well as talking about what the CMA and its partners are doing to stop it. And then we'll go into some of the details. We have some experts here to share some of the details about the actual financial implications. So the proposed increase in the capital gains inclusion rate from 50 to 67% would apply to capital gains above $250,000 for individuals. But when it comes to professional corporations, such as medical corporations, all gains are taxed at the new inclusion rate of 67%. So that means 67% of your capital gains are taxed. So this is different than the individual, and I think that's a really important point to highlight because it's been a confusing topic for the general public when we're highlighting this issue because they don't understand the subtle difference between us as medical corporations being treated as corporations as opposed to as individuals where they have that $250,000 exemption. The tax increase is an added burden for fee-for-service, particularly fee-for-service, not only fee-for-service, but particularly fee-for-service doctors who many of those who work in the community, particularly the family doctors, spend as much as 40% of their gross income on overhead costs like staff, like essential medical supplies, like office space, rent, utilities. And none of us have the ability to adjust our fees like other small businesses might be able to do because we are subject to the agreed upon rates with our provincial or territorial governments. The change is particularly demoralizing for practitioners who plan to retire in the next few years. Approximately 60% of Canada's 96,000 doctors have set up a medical corporation to manage expenses and save for retirement because the majority of us don't have any of those benefits. We don't have paid maternity leave, pension, sick time, vacation time. And because every dollar of capital gains realized in a corporation, even a medical corporation, is currently being subject to the higher inclusion rate, many incorporated physicians will be deeply affected by this as they're moving towards retirement and starting to pull money out of their savings. This tax squeeze, though, also does impact younger physicians and medical students because they're at a time where they're making decisions about their future career, and this may discourage them from considering community-based care at a time when Canada desperately needs more family doctors. It's because of this that the CMA, as well as our partners in the provincial and territorial medical associations, I think some of whom have joined us today, have repeatedly called on the federal government to reconsider this change and exempt physicians. We've asked for them to be exempting medical corporations altogether. We've also asked for the $250,000 exemption that applies to individuals to apply to medical corporations. We have made submissions to the Standing Committee on Finance and the Department of Finance. We also sent letters to the former Finance Minister, Chrystia Freeland, and that was CC'd to the Prime Minister as well. And it was sent in solidarity with provincial and territorial medical associations and in support as well of industry and business associations across the country. We have also done almost 50 interviews on how the proposed changes will impact access to care, media interviews, that is, and generated more than 4,000 mentions in the media. And I think Dr. Ross has also joined us today and has been part of that work as well. And so we continue to advocate on your behalf. This is what appears to be an unintentional impact of these changes to the capital gains, but one that is going to cause problems that or exacerbate problems that already exist in the health system. On January 15th, together with 10 of the provincial and territorial medical associations, the CMA sent a letter to the new finance minister, Minister Dominic LeBlanc, asking him to direct the CRA to immediately stop collecting the tax from medical corporations at the higher inclusion rate and to permanently stop the implementation of the tax increase in the future. And we will continue to do whatever we can moving forward to continue this fight. But now I'd really like to hand it back to Tristan and bring in some tax experts who can answer more of your specific questions.
Thank you, Dr. Reimer. So I'd now like to invite Marty Clement, Regional Tax Leader at MNP, to share more about what you need to know about the increase to the capital inclusion rates and how it affects your medical corporation. Marty is responsible for developing income tax strategies for professional clients of MNP, including partnerships, trusts, corporations, and individuals. He also has extensive experience advising medical professionals across Canada in all areas of domestic tax. So welcome, and over to you, Marty.
Hey, well, thank you very much, Tristan. And before we begin, I'd really like to thank the CMA and its members for the opportunity to present today. It's a real privilege for MNP. So we're looking forward to alleviating some of the confusion and some of the anxiety that Dr. Reimer was referring to. And, one of the goals today really is to provide anyone who's listening with information, concerning this, so that you can have informed conversations with your advisors as we approach tax filing season. There's a couple of comments I just want to make about the presentation just generally here. For today, we've set aside a lot of the minutia just so we can sort of focus on sort of the bigger issues. So if there's any questions concerning maybe some of that minutia, we're happy to take that at the end. And lastly, we may potentially find ourselves in a situation where this is a very fluid situation that may develop differently. So we're sharing with everyone today as best as we know today. And this might be a storyline that you need to sort of stay tuned for. So we'll go to the next slide. So just briefly, what we thought we would do here is just refresh ourselves as to what a capital gain is and what it's going to cost. So for a physician, a capital gain typically arises when you sell land or building. It might be your clinic, maybe a recreational property, the family cottage, EFTs, shares. Those would all be considered capital property. So you're going to have a capital gain when you've got proceeds of disposition. So that's the top left box. When that exceeds your ACB, that's your adjusted cost basis. That's the amount of money that you would have spent on the property. You're going to have a capital gain. So under the current rules, capital gains are taxed at an inclusion rate of 50%. Okay, and so that means that half of the capital gain is taxed at the regular personal corporate rates. And that amount is then sort of brought into your income and subject to the marginal rates of tax. So in a simple example here, if you received $200 for shares that you sold and you were into it for $100, you would have a $100 capital gain. That's multiplied by the current rate, which is 50%. That's the inclusion rate, and you'd get a taxable capital gain of $50. So that $50, would be included your income, and then subject presumably or potentially to 50% tax rates again. So we just sort of thought we would just talk about the inclusion rate there because it is separate than the tax rate. So on April the 16th, on the next slide, on April the 16th, the federal budget proposed to increase the capital gains inclusion rate from 50% to 2/3 for dispositions that happened on or after June 25th, 2024, with different rules applying to different taxpayers, just like Dr. Reimer had shared. And so, while the inclusion rate had moved in the past, I think one thing that's notable here, and one of the reasons why it was such a big deal, is that it hadn't changed in 24 years, which would be more than a generation. So just as a reminder, the tax rate didn't change, it's the inclusion rate. So just using our simple example, okay, from the prior slide where we had $200 of proceeds, $100 of ACB, we had a gain of $100. In our previous example, when the inclusion rate is 50%, we would have $50 going into our income. If the proposed changes are enacted, okay, we would take the $100 gain and we would multiply it by 67%, and you'd have $67 going into your income. So your income is $17 higher, and you're going to pay tax on that amount. So that's why it's very costly. So on the next slide here, we thought we would share this slide because it pulls in a lot of the provinces. And when we're thinking about filing our tax returns this year, and we're going to get to that in a couple of slides, it's important to differentiate what your effective tax rate is between the current and the proposed rate. So for example, here in BC, okay, your effective tax rate is sort of in that light blue under the proposed rate. So if the proposed capital gains inclusion rate increases, your effective tax rate on a capital gain goes up by about 8.92%. So it's about 9%, fairly on par with some of the other provinces. So one of the key takeaways here is that if you've got a corporation and you've got a gain that's potentially subject to this higher rate, you're looking at about 8 or 9% of additional taxes. So just a couple of comments here in the context of professional corporations, which are very important because they're typically used as a retirement vessel for physicians. Physicians can't sell their practices generally, so it's really important to save up in these and to fund your own retirement. Sometimes we'll hear from a younger physician that, well, I haven't necessarily had a chance to save yet, so maybe these proposals are not as bad as I think. What I would suggest to the younger physician is that the proposals aren't going to affect your ability to accumulate money from your professional earnings. What the proposals are going to take aim at is what you do with your savings, and when you invest them, and when the investment grows, and over the course of your career, when you're buying and selling your investments or rebalancing your portfolio, there's going to be a higher tax cost, okay, making it harder to save for what you eventually need for. I mean, if you're sort of mid-cycle or mid-career, you're going to have that same challenge. You probably had some challenges in and around June, trying to navigate the potential change. And then finally, I think at or near retirement, it's important for, if you're in that sort of stage, I mean, you're selling your investments to fund your personal lifestyle. And so when you're selling your investments and a higher rate of tax is potentially going to apply here, that means less money for later. These changes also sort of find their way into insurance discussions, estate planning, and a whole host of other areas. But we'll sort of leave it at that, and we'll just sort of take a look at the next slide here, which is a bit of a roadmap, and it just sort of highlights some of the implementation here. And I know there's some comments about just sort of the uncertainty surrounding all of this. And a couple of highlights here. So when the budget announced this, and that was back in April, there was about 10 weeks for Canadians to organize their affairs and sort of say, look, do I want to save the 8 or 9% taxes by realizing gains before June 25th, or do I want to wait it out? That was done so without legislation. Okay, so there was an announcement. Canadians were operating without legislation. About 2 weeks before June 24th, the first cut of the legislation came out. That legislation was amended. There was a number of technical matters that needed to get fixed up in it. That came out on August 12th. So we kind of knew the playground rules after the effective date of the proposal. And then, just like Dr. Reimer said, in September of 2023, a notice of Ways and Means motion was adopted in the House of Commons approving the measure. And the measure is the capital gains inclusion rate, amongst other things. But importantly, that bill was never tabled or presented to Parliament. Okay, so it never became legislation. So in and around September, the incumbent government was sort of facing some uncertainty. There was talk about non-confidence motions, and then there was more uncertainty as to whether or not these proposals from April would actually be enacted. So fast forward a little bit, and so we know that Parliament, the Governor General, on the advice of the Prime Minister, prorogued Parliament in January. The CRA has came out and said what they've said. And you know what? There's a whole bunch of ongoing speculation as to how you file your tax return. But I think on the next slide here, what we're going to do is just talk about exactly where we're at. And then from there, we're going to just look at some examples for, professional corporations. So when Parliament was prorogued, it terminated Parliament, including bills that hadn't received royal assent. And we know that the Notice of Ways and Means motion that included the capital gains inclusion rate, that wasn't voted on before prorogation, and there was no bill. So again, Dr. Reimer had said that if there's no bill to increase the capital gains inclusion rate, it's going to have to happen when Parliament in its next session. So the government's prorogued until March 24th. So we're going to get into March, April, and we're not necessarily going to know if this is actually going to be passed as a bill or not. So I think given our current political situation and considering where we are today, it's possible that we may not know whether or not the proposed capital gains inclusion rate will become law prior to filing our taxes. So I think, ultimately here, a prorogued Parliament creates a situation for Canadian taxpayers where the current law says the inclusion rate's 50%. Okay, but we've got proposed legislation that if it's passed, it would retroactively apply, and it would require a Canadian taxpayer to use the inclusion rate at 67%. So the CRA recognizes and that the proposed changes are still subject to parliamentary approval, but the CRA has said, look, we are going to leave this off, or we're going to assess tax returns on the basis of where Parliament left this off, which is that in November of 2024, the Notice of Ways and Means motion, there was intention to sort of implement this. So the CRA is going to assess tax returns on the basis of proposed legislation, not actual legislation, and voluntarily ask Canadians to pay more tax. So what they're doing is that before the end of the month, and just a couple of days away from now, they're expecting to have their forms updated, their schedules updated to accommodate this higher inclusion rate, even though it's not law. So interestingly enough, Canadians have filed tax returns with tax software that didn't have the 67% inclusion rate. It only had the 50% inclusion rate. So the CRA has said to those taxpayers, like, look, if you've got a due date before March 3rd, you can fix those tax returns up, pay the additional amount of tax, and we won't charge penalties or interest. So on the next slide here, we've sort of kind of called this a bit of a dilemma. And the dilemma being is that professional corporations and physicians are responsible in 2024, as it stands right now, to file your tax return based on the current law, which says that the inclusion rate's 50%, or the proposals, which we're not sure if the proposals will actually come through. So there's two simple questions there. So you kind of have, does a pro corp or a physician voluntarily report the gains, just like the CRA is asking them to do, and report at a higher inclusion rate now? And we'll talk about the risks that are assumed with that. Or do they report using the current law? And there's going to be risks associated with that as well. So any way that this is sort of shaping up, a taxpayer, as it stands today, is going to have to predict the future a little bit and take on some risk in terms of their tax filings. So the next slide here talks about professional corporations, and I'm going to spend a minute or two on this slide. And so let's make a couple assumptions here. So a lot of professional corporations have December year ends, so we're going to go with that. We're going to assume that you've got a period 2 gain, so you've got a capital gain after June 25th. And we're also going to assume that the quantum, the amount of tax that we're talking about between the 50% and the 67%, it's material to you, okay? So when you step back and say, well, how do I manage this situation? Well, just recognize that if you've got a December year end, the first thing that you would do is you'd say, well, look, I don't have to actually file my taxes until the end of June. You may have April, May, and June, some time there to sort of see how this plays out, to understand or to pick a tax filing position. You know, some time may elapse and this might clear things up. Now, having said that, you don't necessarily have the luxury of time in terms of paying your taxes owing for 2024. So just their taxes owing for 2024 would be owed by the end of February. So that by the end of February, you're going to have to make a decision as to, well, am I going to remit the payment based on 2/3 or 50%? Filing your tax return is a different matter. I would say, conservatively speaking, if you remitted your tax on the basis that the 2/3 inclusion rate was going to be enacted, okay, you could sort of do that, wait and see how this, you know, pans out, and then potentially look at, you know, recovering the money later when you're filing. So that's for a December year end. Now, look, you might be required to file a tax return between, you know, now and maybe the end of March. Like you've got a September year end. So a September, and so again, corporations have 6 months to file their tax return. So if that's the case, you've got a couple of decisions to make. And so, you know, your option 1 here is just sort of articulated on the screen is, you file your tax return based on the proposed law. So do I calculate my capital gain at 67% and file it? So look, let's sort of see what happens if we do that. So let's do that. And so then we wait and you sort of say, well, if the legislation passes and this capital gains inclusion rate is ultimately enacted, well, I've calculated my income right, I've paid my taxes, so I'm good. If the legislation does not pass, okay, well, you've absorbed some risks here, okay, and the risks you've absorbed are you've overpaid your tax because you've paid it on the 67% and the actual law is 50 and it didn't actually materialize. It's got that may have some cash flow implications for you, okay, and I think one of the realities here is that when you go back and fix all of this up, it costs money to amend tax returns, okay, and seek your tax refund. So the other option that you would have is that you would say, well, what if I filed based using the current law? Okay, so that's the 50% inclusion rate, and that's what the law says right now. So again, you'd say, well, I'm going to do that. What could happen? Well, if the legislation is enacted, okay, well, we'd be down the road, and what we would say is, well, we filed it based on 50. The legislation was enacted. You know, the tax rate was actually 67%, or the inclusion rate was 67%. So we're going to have to absorb the risks of amending tax returns, paying the additional tax, and potentially high levels of interest on that. Now, if the legislation does not become enacted and we've put the 50% inclusion rate in the return, well, we've calculated the taxes correctly and everything's been filed and we're okay. But you can sort of see under each option here, there is an element of uncertainty in terms of, you know, how this will play out. So there's no real option, I think, here where a taxpayer can say, look, I'm just going to pick one option and, you know, I'm going to be fine. I'm going to leave out the discussion on dividend refunds, your capital dividend account, and your small business deduction, because there's a whole set of issues that, you know, arise depending on what the inclusion rate is. But we're going to leave that aside for today and just go to the next slide here and just try to finish this off. So, you know, if you're an individual, okay, so we're not a professional corporation, there's a couple of things. You're pretty much going to have the same options. Do I file based on the current or do I file based on the proposed law? But, you know, this is something that'll probably be more relevant in April. Hopefully we have more information by then. So for the end of April, you're going to want to pay your taxes. Okay, your taxes are due, but physicians often have self-employment income. So whether they're teaching or administrating or doing whatever it is, that may push your tax filing to June 15th. So if you've got a June 15th filing, okay, and we're not clear as to where this is going to land in April, you could maybe push your filing out, but you'd want to be very careful that you've considered how much tax to pay by the end of April. So taxes are owing in April, tax returns might be due for the end of June. Okay. So on the next slide here, what we've got here is just a little bit of information of trusts and partnerships. And so trusts and partnerships have accelerated deadlines. So they file their information returns by March 31st. And it allows beneficiaries and partners of partnerships to have information so they can be compliant basically for the end of April. Partnerships and trusts for this year are going to be required to disclose whether or not they've got a gain in period 1 and a gain in period 2. So when you're in receipt of a T3 slip or a partnership slip this year, expect more boxes, expect more information. Okay, but one thing that might be of interest this year, and we're not sure how it's going to play out, is that a trust that has a capital gain in period 2 will disclose that it's got a period 2 capital gain. Okay, the recipient of that information then goes and files their tax return. They go through that decision making. Well, do I file based on the current or do I file based on the proposed? What's not clear this year is how the CRA slip matching will operate with your tax return. Because on one hand, you'll have trusts and partnerships, clearly disseminating between period 1 and period 2 gains. And then you're going to have people who've received those slips reporting on their tax return that's potentially different. So if anyone's ever filed a tax return with a tax slip that has some information in it, and it's a little bit different on your tax return, it usually invites CRA follow-up. So we'll have to sort of see how that plays out this year. So be careful with that if you're in receipt of those slips. The final slide that we have here, just to kind of note a couple of areas of uncertainty here. So just briefly here, the September 23rd Notice of Ways and Means motion proposed increasing the lifetime capital gains exemption. So that's a really good deduction if you've sold shares of a private company. You can sort of exempt a fair amount of tax. Now, physician professional corporations, as I made the comment earlier, are usually retirement vehicles. They don't sell, but that doesn't mean a physician can't exercise or use the lifetime capital gains exemption if they're invested in something else. I would just suggest that if this is in play for you, please get some advice sooner rather than later, I would say there. And then, my last comment here is that on December the 30th, an announcement was made by the government. It was in connection with the postal strike. So the postal strike happened, and the government was concerned that Canadians weren't mailing checks to charities. And so the government said, look, if we're going to make this announcement, if you make a donation to a charity by the end of February, we'll let you claim it on your 2024 tax return. So we were sort of cautioning clients at that point that that announcement's out there. There's no legislation to support that. It's just an announcement. And then on the 23rd of January, the CRA said, look, our administrative position is going to be that, subject to some exceptions, we'll allow that practice to happen. So I think if you catch yourself in that situation, the administration seems like you've got a green light, but just keep in mind that the legislation does not yet exist for that. So anyways, that's my final comment on that. And I just would like to thank everyone for their attention, and I can maybe hand it back over to you, Tristan. I think you're going to be moderating the question and answer period.
Yes, yeah. Thank you, Marty, for providing some clarity on the situation. So now we're going to open it up for questions from everyone attending. So if you have something you want to ask, please add your questions to the Q&A tab, which should be at the bottom of your screen. And as the questions come in, you can also upvote questions that you'd like to get answered from us. So as a reminder, we have Marty on, we have Dr. Joss Reimer on. We also have Simone Reitzes listening in, and she's the managing director of the Medicus Pension Plan, which was established by MD Financial Management and Scotiabank. So as you're putting your questions in, we ask that you please keep them on topic to capital gains. And also, please don't share any personal financial information. It's difficult to comment on your individual situation. So please ask that if you want to get into your situation, please ask in a general fashion if possible. So as you are thinking of your own and we see the questions start coming in, I'm going to start off with a couple of questions that have come in from the CMA's own engagement on this issue. And this first one is for Marty, and I'll just ask it. Does incorporation still make sense for physicians?
Yeah, that's a great question. So I think the key thing with incorporation here is that when you decide to spend the money to set up a corporation, what are the benefits, for the individual, the physician. So I think, again, these changes don't necessarily affect the decision to incorporate or not. The key thing with incorporation is you're going to earn what you're going to earn. You take what you need and you leave the rest. And leaving the rest means like leaving the money in the corporation. So I think as long as you're leaving an amount of money in the corporation where the tax is deferred, it certainly makes sense. Again, now these changes are more targeted as to, when you leave the money in the corporation for investment and growth, these changes are more targeted at that growth, right? And sort of taxing that. Incorporation, I would sort of generalize and say that if you're incorporated versus not, you're going to have access to different financial opportunities. It's more effective to fund life insurance. You can maybe participate in a pension plan. There are other things that you can do to maybe diversify and manage your affairs. So I think it's still a good thing to do. And these are just proposals, remember?
Great. Thank you, Marty. And the next question is for Simone, Managing Director of the Medicus Pension Plan. Would investing in a pension plan be advantageous given the potential for a higher inclusion rate on capital gains?
Yeah, thanks for the question, Tristan. And I think that the good news is deciding to invest in a pension plan like Medicus or in your own medical professional corporation is not an either or decision. You can absolutely do both. A pension plan does operate similar to an RRSP with the tax limits that you're able to contribute, which means likely only a part of your savings are going towards growing in that pension plan. And what the pension provides you really, as Marty mentioned, is diversification. So contributions to a pension plan like Medicus come from your corporation and help give you different ways to save for retirement on a tax effective basis. So while you'll have some of your savings in your corporation, having some of your savings in a different tax sheltered vehicle where you get those tax deductions, the assets grow tax free, you have the opportunity for pension income splitting in retirement is a nice way to make sure that when tax policy does change, because even if this one doesn't go through, we can't predict what will happen in the future, you have savings that are more resilient to those changes because you have savings in different types of vehicles.
Thank you very much, Simone. Okay, so this next question is for you, Marty. What are the implications for real estate proceeds, both ongoing rental income and or the proceeds of disposition of real estate assets?
Okay, well, let's start with the sale of real estate. So a couple of things to consider there is that if your real estate has increased in value compared to what you've paid for it, that when you sell it, okay, remember that profit that you would realize under the current rules, half of that profit gets included in your income. Under the proposed rules, okay, 2/3 of that profit would be included into your income. So when you go to sell the real estate down the road, just in my example there, if you're a high rate taxpayer, your tax cost is going to be anywhere from 8 or 9% higher than it otherwise would be. So you're going to take home less by selling that. Okay. Now, in terms of the rental income that you're going to generate from between today and the day that you sell it, these proposals, okay, are sort of targeting capital gains, and so that's what happens when you sell the real estate. These rules aren't targeting the ongoing income that you would generate from the asset. Those rules are, I think those are 2017 rules where, your passive investment income, if it starts to exceed 50,000, may start to erode your small business deduction, but there would be a separate set of rules that would deal with your rental income.
Great. Thank you very much, Marty. And this next question is directed at you as well. Could you please explain what the lifetime capital gains exemption means and when is it applicable?
Yeah, thanks for bringing that up. I was short on the presentation on that one. So the lifetime capital gains exemption is a tax incentive that's been around for a number of years. And the idea there, when it was first established, was that as a small business owner, you're going to be investing into your small business. You're not going to have money to your RRSP. And so when you sell your small business, you know, what's similar to obtaining a pension, like you should have something there at the end of the day. So the idea there was is that if you sold your business, the shares of your business, okay, the capital gain would be exempt from tax if your business met certain criteria. Okay, so the lifetime capital gains exemption is a benefit you can obtain if you sell shares of a private company. Okay, that private company meets certain tests. The capital gain that we're realizing on those shares would be exempt from your income. So it could be tax-free. So in budget 2024, one of the good things that was in there is that the exemption limit for your lifetime actually increased to $1,250,000. It was previously cruising around $1 million. So they actually said, hey, look, if you sell these shares, you can exempt more of that gain from tax. And then I sort of made the comment that physicians generally use their pro corporations for other reasons, right? So physicians will save in their professional corporation. It's a retirement vessel. They're not selling their professional corporation or their practice when they conclude their practice, not selling those shares. So we don't see professional corporations typically sell, but physicians do invest in other businesses that may qualify.
Great. Thank you very much, Marty. And the next one is for Dr. Reimer. Why is the CMA advocating on this issue?
Yeah, so we heard from a lot of physicians when this came out and heard concerns, especially I would say from family physicians, because they're overrepresented in those who work in the community and who have large overhead and also have lower income compared to most, but not all specialists. And so that was a big part of why we were advocating for this, was because we heard from so many physicians about their concerns and the financial impact that it had on them. We also spent time talking to stakeholders, in particular to the provincial and territorial medical associations, and worked alongside with them to make sure that our messaging was consistent with what they were hearing from members and what they wanted to express as well. I think at the end of the day, when it comes to the health system, we see 6.5 million Canadians who don't have access to a family doctor, and the numbers don't seem to be going in the right direction. In fact, the CIHI report from this year showed for the first time in decades that we've had a decrease in the number of family doctors in Canada, which to me is particularly concerning. And so anything that discourages people from pursuing family medicine, from working in primary care settings, is going to be just one additional barrier, one additional hurdle that works against what we're trying to do to improve access for Canadians. And that was the big concern. So this is a personal belief. I don't have any way to know the intentions of the government. I don't think they were intending to tax our family doctors personally, and I don't think they were intending to have the impact that they did. And so for me, it was important to make sure that they understood the impact that it was having in the case that my assumption is correct and that they didn't understand the impact on physicians and the way medical corporations function. And we wanted to raise that with them so that they could make an informed decision about this tax increase and how it might have implications for the healthcare system and access to primary care in particular, although not just primary care, for Canadians.
Thank you, Dr. Reimer. So we have more questions to get through here. The next one is for you, Marty. Is there a chance that there is a special provision in the law to keep the tax rate at 50% specifically for physician corporations, since this serves as the pension fund for many doctors?
Truthfully, there's not a specific provision for that. I would love it if there was. Yeah, I think you're raising an interesting point there, is that, look, when the inclusion rate, one thing that's really interesting here, if the inclusion rate is proposed, if it increases, if the inclusion rate increases, and if you've had an asset for the last 10 years, you bought probably that asset thinking that the inclusion rate was 50%, it's gone up in value. Now, if the inclusion rate goes all of a sudden to 67%, it has the practical effect of retroactively taking tax out of that gain from 10 years ago, because the gain is accrued over time, right? So if the inclusion rate increases, it results in extra tax that has been accruing over a period of time. Unfortunately, there isn't something to specifically exempt medical corporations.
Great, thanks, Marty. And a couple more questions here for you. The first one is around property. So if you own a rental property personally, opposed to via a corporation, how does capital gain tax apply?
Yeah, so the capital gains tax here under the proposals, if you sell your rental property, okay, the first $250,000 of your gain will be taxed at 50%. Okay, so the gain in excess of 250,000 will be subject to that 2/3 or the 67%. So the point was made earlier in the presentation where rules for a professional corporation are different than the Canadians individual. The Canadian individuals have a $250,000 threshold where the 50% inclusion rate generally would apply, and then gains on top of that would be 67%. So I think you're going to pay less tax on a gain as an individual versus the corp if you ultimately sell it.
Great, thank you. And this next question is around, what happens if there's a new government? So, what happens if there's a new government and the capital gains proposals are no longer in place? Do you think Canadians can protest the back payment of tax or interest since the prorogation has nothing to do with Canadians?
That one's for me.
Yes.
I'm just joking. So, yeah. So what's interesting here is that the opposition party has said, look, if we get into power, we're rolling that back. So they're not going to proceed with the capital gains inclusion rate and the change. So they've said that. So whether or not that materializes, that's different. It kind of goes back to that option we were talking about. Option one, option two. So again, if you file your taxes this year and you select, I'm going to file on the proposed rate, right? So I'm going to pay my taxes at 67%, and that doesn't materialize. Well, the law was 50%, and if the new government comes in and they're able to, make it such that this proposal never comes back, then you've got to go back and amend your tax return and seek a refund. So administratively, there's some work to do to go and get your money back. On the other hand, if you think that that's going to happen, the law says you can file your tax return at 50%. So you'd file your tax return at the 50%. If you truly believe that's going to be the outcome, and in fact it does materialize, then you're fine. There's nothing to do. So, that is the difficulty this year, I think, for a lot of Canadians, just given our political landscape is, what's going to happen here, just given, all the speculation that's out there, and how should I file my taxes, right? So, there's, like I said, you're going to have to assume some risk, I think, as it currently stands when you go to file your tax return.
Great, thanks, Marty. We don't see any more questions in the Q&A, so we'll just take this time just to remind everyone, if you have any questions at all, please submit them to the Q&A box at the bottom. But actually, I'll ask one that we've received from past engagement on this issue, and this one's for Dr. Reimer, and it's based on your experience. What is the likelihood that candidates for the federal election will keep their commitment to get rid of the capital tax increase?
Boy, that's an impossible question to answer. That's like how good are politicians at keeping their promises once they're elected? I mean, the Conservative Party has been very vocal about their plans to roll this back. So I think it's more likely than not that they will roll this back. I know that Chrystia Freeland has now also said that if she becomes the leader of the Liberals, she's planning to roll this back as well. So I think there's much more than a zero possibility that this does get rolled back. But we've seen many times where people say things during elections. We talked about how we were planning to change the way we vote for government. There was a whole plan for us to switch the way we submit our ballots and how we rank candidates, and that never happened. So I think it's not something that we can predict with certainty, but this one seems like a less risky proposal than perhaps some of the other election commitments that people make. But Marty also maybe has some thoughts on it, because I can see him sort of. shaking. I don't know.
No, I'm agreeing
Wondering
with you.
in the
Yeah, no,
background.
I'm agreeing with you absolutely. I guess I'm just thinking about all these possibilities as well, right? Because you're trying to think about the future. So no, I agree with you. I think potentially there is a world where the new leader of the Liberal government maybe strikes a coalition with the NDP, and the government lives till October. That could happen. So if that's the case, would the bill be reintroduced and passed? Possibly, right? But again, it's all speculation, right? I think there's some all interesting things that are maybe happening. You might see happening in the courts in the next couple of weeks with this too, and whether or not the CRA actually can assess tax based on proposed legislation. So it's one of those things where I think you've just really got to keep your eye on it, and certainly talk to your advisor before filing taxes.
Great, thank you both. There are a couple more questions here, both from Marty, I think. So the first one is, what are the penalties if the tax filings and payments are underreported?
Yeah, so you know what, the penalties here I think is an interesting one. So if it's underreported, what I would sort of say is that I think it's difficult for the Canada Revenue Agency to impose a penalty on somebody who's filed their taxes based on what the law says right now. Okay. So the Canada Revenue Agency is saying file your taxes based on these proposals, and if these proposals come true one day, then yeah, retroactively you owe it. So I think you're probably more in a situation of interest. Okay, now I can't guarantee that because the CRA system is highly automated and there'd be a lot of taxpayers potentially affected by this. But I would sort of say that right now there's not interest relief. So if you do end up owing taxes, you would owe the taxes from your balance due date until the day you pay it. And the current rate of interest right now is around 8 or 9%. So it's not nothing in terms of paying the interest. So I think you'd be looking more at interest rather than penalties, but that could be different, but that's what I think currently.
Great, thank you. The next question is, if I inherit a family cottage from grandparents who have passed, how do capital gains come into play?
Well, grandma or grandpa, whoever bequeathed the property to you, would pay tax at the fair market value. Okay, and so what you'd want to do there is understand what the fair market value of the cottage was when you inherited it. That forms your new cost basis. Okay, and that's important because if you ever sell the property later or will it to someone in your family, you're going to have that proceeds of dispositions at that time. So you're going to want record of what the adjusted cost basis is so that you can manage or understand your capital gain as best as possible. And then depending on what the rate is, 50 or 67%, you would pay tax if you ever sell it down the road or transfer it.
Okay, another one for you, Marty. Would family trusts be treated the same way as a medical professional corporation or a holding company?
In the context of capital gains?
Yes, I think so.
Probably, eh? Yeah. Okay. So, this is an interesting one. So a family trust would not have the $250,000 capital gain threshold that an individual would have. So in that case, it would be treated more like a corporation if the trust retained the capital gain. Okay, so trust can pay tax. Now, trust can also take the capital gain and distribute it to the beneficiaries. And so if a trust distributes the income, it doesn't pay tax. The recipient of the income is the one that pays the tax on it. So the trust could, in theory, distribute a capital gain to a number of beneficiaries and access the $250,000 threshold a few times. So it's maybe more like a corporation, but it could convert itself into an individual setting. It depends on how you're looking at it, how you want to plan with it.
Great, thank you, Marty. And I believe that is all the questions that we have. Just going to do a last check here. Okay, so that ends our Q&A. So just want to thank everybody for all the questions. Really appreciate those coming in. Oh, actually, hold on. I see that there's one last one that's come in. Just give me 1 minute. And one last one for you, Marty. Will the gains be calculated on a linear basis for the entire holding period, or can the calculation be split at the point when the new law takes effect? That's the first part. If it can be split, would you recommend investing in corporate assets or real estate before the new law begins in order to optimize tax benefits?
Yeah, good question. So, look, if as it's drafted right now, if it is enacted, um, the increase to the inclusion rate applies to the gain as it occurred in a linear way. There's no sort of partitioning, the gain the between the 50% and the 2/3. Like you can't do that at this point. Now, before June 25th, because of that reality, a lot of Canadians were looking at their property and sort of saying, there's a gain on this property. Do I want to manufacture a gain now and sort of prepay my taxes with the 50% inclusion rate versus, paying the 67% inclusion rate down the road? So, back in June, you would have seen a lot of Canadians dispose of property, to potentially save some taxes. Sometimes it made sense. Sometimes it didn't necessarily make sense from a financial perspective.
Great. Thank you very much, Marty. Okay, so that ends the Q&A. Again, thank you all for all of your questions, and I just am going to pass it to Dr. Reimer to start closing us off.
Great. Well, thank you, Tristan. Thank you to everyone for sharing your concerns and your questions, and a special thanks to Marty and Simone for their insights and their expertise. It is a complicated topic, and so we hope that this conversation has helped clear up some of the confusion around the CRA's decision and offered some options on how to approach the tax filing season. The CMA will keep on top of this issue, and we welcome you to join us. So if you're interested, for example, in learning more about the Medicus Pension Plan and your RRSPs, MD Financial Management and Scotiabank will be hosting another webinar on February the 10th on that topic. But if you're interested in getting involved in our advocacy, you could consider registering for the CMA Health Summit in March. We will be offering an accredited course in mobilizing change in healthcare, and we would love to have you there and see as many physicians as possible at that health summit. Together, we can keep healthcare on the national agenda and ensure that physicians stay focused on what we do best, which is helping patients. So one last thank you to everyone, and I will pass it back to Tristan for some final details.
Great. Thank you, Dr. Reimer. Just a quick note, we put a link to the webinar from Medicus that Dr. Reimer just mentioned in the chat for those that are interested. And before you all go, we ask that you please stay on just for one more minute just to complete a very short poll. It's only 2 questions. And I believe it's coming up now. Your feedback is valuable to us. It helps us get better at doing this and ensuring that we can provide you with the information that you need in future sessions like this. So the poll is up now. There are 2 questions. I believe you need to scroll down to see them both. So if you can take time to do that, that would be much appreciated. We will also be sending you a longer evaluation form after this session if you'd like to provide more feedback to us. And we promise that, my team reads this and uses it to inform our work. So, oh, actually, just making sure the second question's coming up. There we go. Great. And with that, on behalf of the speakers and the CMA, just want to thank you all. Merci. Thank you for taking the time to join us today. Have a great night.